Welcome back to the Big Skinny with Lou Basenese, and I'm still Lou Basenese, your host with most of the information, but I'm going to bring in a guest here shortly after we answer a quick question that has a lot more information for you on innovation, ETFs, and technology. But Chad jumping in the conversation again, saying he's all ears to learn more about ETFs. He's pretty strong in Hack, which is the cybersecurity. IYH, I don't know it offhand. XLE is the energy one. Love me some energy, trading at about 15 times earnings, that sector. So he wants to grab more. And you know what, Chad? Thank you for setting this up so perfectly for a conversation with John Tinsman, because I'm going to tell you what he won't tell you. It's one of the best performing ETFs this year and going back since its track record and founding. It's the AOT Invest Innovation and Growth ETF. Without further ado, I'd love to welcome John Tinsman to the show, the founder and the young stud behind all the success, man. Good to have you, my friend.
Yo, Lou, I could hear you before. Can you try talking?
Can you hear me now?
All right.
All right.
Somebody
We're back. Look, you're so young and successful. We try and want to make you stumble and make it harder for you. Like, we're just going to cut off audio so you can't answer questions. But I was giving you an intro just saying how well that your ETF has performed. So why don't you tell everyone about the AOTG ETF? What's its foundation? What's the overarching principle? And then I'm going to kind of pick apart some of the picks and just riff with you on how they make it in the portfolio, and we'll talk through it from that standpoint.
Great. Well, you know, it's an honor to be here with you today. It's good to see you again. So if we keep doing this, we're going to end up being best friends because I see you like all the time now. But
let's do it.
I mean, what I did was I looked back at like all of the history of investments, and I realized that growth was outperforming, value and core. That large cap was outperforming, the other caps by, pretty significantly. Maybe you've seen that like Morningstar chart.
Yeah, much to my chagrin, because I'm a small cap guy. But you're right. I'll give credit where it's due. Large caps crushed small caps lately.
Technology was beating everything else, and so I was like, well, like if you want to have a successful fund, it sounds like it needs to be a large cap, growth technology fund, and that's exactly right. Those are the very best funds in the whole market. But then there was a question of, I was buying other stocks that were doing really well that didn't fit into this category, right? So in this category, there were included companies like Visa and Google and Amazon, and none of these are considered to be technology companies. They're considered they're in different sectors. So right. I was like, well, there's got to be a better way to include these companies to increase diversification and actually also raise returns. So I started calling it low marginal cost. And low marginal cost is like the cost that takes to produce one additional unit. So basically companies like Visa, it doesn't cost them anything if you swipe your credit card one more time. They just make an additional fee. And that fee it usually converts to a really high profit margin, which is good for investors. The cost to grow in these companies is actually free, basically, because all it costs is for the demand to be there. So basically they can grow without debt, unlike other companies, like say like a fertilizer company would have to, build more factories, and airplane company like Boeing would have to build more factories. The growth is very expensive. A lot of times the growth comes at lower profit margins. This is the exact opposite. The growth is not funded by debt, which is not risky, and it comes at very high profit margins. And then, so basically, like the other thing about low marginal cost investing is it doesn't matter if the extra growth comes at 100% profit margins if the company's not growing, right? So if the company's like not growing at all, you're like, well, it doesn't matter then. So you need the growing companies like AMD and NVIDIA and Google and Microsoft, but smaller large cap tech companies still like Toast and Robinhood. And if you have a portfolio like that, statistically, like in the past, you've crushed the indexes for a very long time.
And I love this for a few reasons. One, you isolated 3 or 4 key factors to outperformance, right? It's large cap versus, not small cap, right? It's growth versus core or value. Profitable was also one of your requirements, right? Which is, in tech space, there's a lot of fast-growing software companies that aren't profitable. So you weed those out. And then low marginal cost. But then more importantly, the back test worked, but now so is the forward test. When you launched this ETF, talk to me about the performance, and then let's get into portfolio so people can really understand the names and the types of companies that are chock full in this ETF. So
Yes.
how's the fund done? I mean, the ETF
Yeah,
done.
so the fund, I think the last I checked, it started trading in the 24s and it was in like the 52s and 51s today. So it's up 100, over 110%. I think it's coming up on 120%. And at the same time, like the S&P 500 is up 60 something percent. So there is like a pretty big spread there. It's done a lot better. The interesting thing is that it's continuing to do very well, and the profitability in these companies, I think, is really what's driving it. So like you mentioned, like not having unprofitable companies, and that's really true. Like when you think about like the .com bubble, right? You think about the Nasdaq like imploding, and like
Yes.
we know the Nasdaq has done better than the S&P 500 by a lot. I think it's like 500 percentage points. Yeah, that's since 2022 in inception. So it started in June 2022. You know what I find is so interesting?
Yeah,
Like
tell everyone what we're looking at here, because some people listen to the podcast, other people are going blind
yeah.
like me. But explain what you've put together, because I think this is a
Yeah,
really
so
powerful
this chart,
chart.
yeah, this chart says that AOTG's rates up 117%, and we're going to start with the other things that aren't AOTG in this chart, right? So the Dow Jones Index, we know this is the index that has the lowest amount of tech exposure. It is up, and by the way, low marginal cost exposure also. So what I found in my research is that low marginal cost exposure is actually very strongly correlated with performance, right? So the Dow Jones has the least of it. It's the lowest, 43% over the last 3 years in like 1 month. All right, then you've got the SPX, the S&P 500. That's up 68%. So then the Nasdaq comes after that. It has a higher proportion of low marginal costs, tech and technology companies. So you can see actually the Nasdaq has beat the S&P 500, and then you can see there's the leading innovation ETF, which is ARK, which actually has a lot of unprofitable companies, which in my research actually doesn't raise performance, which I think is just really interesting because a lot of times people
Kathy
think
Wood is a great marketing machine, but I don't know that her stock selection strategy is as great as the marketing prowess.
Well, the problem is like when you're trying to pick all these like Kathy Wood, right? It's like, well, I've got CRISPR, it's going to cure all these genes, and then I've got this one, it's going to cure cancer, and but none of them have actually done it. And so there's been a long.
It's the problem of being early is you look like you're wrong for a long time. But what you've done is you short circuited that whole pitfall by just going right to successful companies, growing revenues, growing earnings are already profitable.
Yeah, the companies are already doing it. And like a lot of people would be like, well, like, why wouldn't you just buy an index if you want a growing fund? And so I had the VUG, it's the growth index. It's done, better than that one also. And like my research showed it doesn't make sense to only weight by market cap, right? So like market cap it's a good thing to have a factor in, but once you're already in large cap, like, and you're not having a bunch of small cap or mid cap companies, like that reason to weight by market cap becomes a lot less compelling. And it becomes a lot more compelling to weight by earnings growth, right? So like if you were to look at a company like Robinhood, it's growing its earnings at 150%, or Toast, which is another top holding, growing its earnings at like 100 and something percent year over year. You'd be like, well, I hope those have really big weights in like the growth index, right? Yeah. Whether it's like the Vanguard one or the things. And you're like, no, that's like a 0.2% weight in those. And you're like, wait, what? Like, well, what has the biggest weight? And they're like, well, Apple. And you're like, but Apple's not growing at all. Like it's hardly growing faster than inflation. And
you're
like,
going to dog on Apple, but you're not wrong. It's one of my favorite stocks. I'm the unashamed Apple fanboy. But what you're talking about is waiting towards earnings growth. And I've always said earnings ultimately drive share prices, right? If earnings keep growing. So it makes sense that if you focus most heavily and heavily invest in the fastest earnings growing companies, the stock prices are going to go up the most. And that's what you're seeing in the ETF. Is that not right?
Yeah, and I think the biggest reason for that, Lou, like because a lot of people like to talk about an efficient market, but like we all know, like if like you invest in penny stocks, you don't get like a higher return for like your investment, right? Like so, it's kind of like a little bit baloney. But like I think what we're seeing is that people can't analysts can't expect the upside potential in tech, right? So like people are like, oh, Nvidia is up a lot, like. And it's doing well, but like, what do we think it's going to earn more in 2 years? And they're like, well, we know the GPU demand is crazy, but we can't put 18x. So let's just put 1x. They'll earn double.
Yes.
But they earned 18x. 2 years ago, they were earning 18 times less. Isn't that crazy?
No,
so
but
it's
that's
like,
the thing too. Like nowadays, the argument is like, well, the tech sector accounts and tech companies, the 10 biggest companies account for 38% of the S&P 500. It's never been this big, but if you look at the percentage of profit growth that they account for and how big the profit growth has been, it justifies it. And then if you look back at the .com days, like you were saying, there was a lot of unprofitable companies that ran up to stupid valuations. Now we have reasonable or more reasonable valuations and a lot more profits. So you're harvesting that phenomenon in the fund.
Yeah.
How do you rotate in and out? Like is it quarterly rebalancing? What are your selection criteria to swap out of a name? How do you manage the portfolio? Because we talked about this being an active versus passively managed one.
Yeah, well, the nice thing about like the active versus passive is it gives you like a little bit of flexibility. So like when you think about a company like AMD, right? Like we saw last year they really weren't growing a lot, but if you looked at the earnings, you could see that their GPU business had crazy growth, like 50 or 60%, while the CPU business was shrinking. So you could see like in 1 year, like the GPU business will continue to grow and the CPU decline will top off. So it gives you some flexibility to have big weights in what you can see like clearly is coming a very strong revenue like acceleration. Now the way AOTG does rebalances is it does it quarterly, and a lot of that rebalance actually like over the last 3 years, like there's a lot of companies doing really well. So basically, a part of that rebalance is actually diversifying. So basically, like as a SEC diversified fund, I can only have 5% plus positions, total 25% of the fund. And then I also can't be 25% or more in any subsector. So like say semiconductors. So a lot of that is actually taking risk off the table, putting it into that next area of growth, right? And
so it's a tactical forced rebalancing, right?
And then the other part of that, is the company is like what has stopped growing and what do you get out? Because you're trying to focus on the growing companies.
And then, so talk to me about the largest positions in video. What's the second largest that people, let's talk about second largest, why, and then what's the most recent addition to the fund?
Yeah, so Robinhood is the second largest, right? So the reason there is that they continue to provide a lot of value to people, like in a way that I haven't seen, right? Like they could have counted themselves down and out after the GME thing, but their CEO Vlad is a big innovator. I love those people like that, just including like Elon Musk, that they don't allow themselves to get knocked down without getting back up and keep going, right? So that's like a good thing to see. What they're doing, tokenizing stocks and breaking down barriers to cross-border investments, I think is like very, very bullish. And I like the next quarter, we're going to start seeing like some of the results of that from their European numbers. So I think that like basically they're a company that's a software company, even though they're in financial services. But what they do is they automate brokerage services, right?
Yes.
So they're basically what they're doing is that they're trying to make it very, very cheap by automating everything and passing that savings on. And what's crazy is like my neighbor's using Robinhood, but then like I watch the All In podcast and like all of the All In podcast billionaires are like holding up their Robinhood like gold cards. So it's like clearly like it's kind of like breaking down barriers across demographics also to attract a lot of unique different people. And that means that like everybody's finding value in it, which I think is a good thing. The international expansion, look, if we know anything about American software companies, it's that they build it in the US and then they sell it at the rest of the world at 100% profit margins and blow everybody away by like how much they grow and how profitable they are. So
yeah, no, it's just the natural expansion. And then I think it's funny too, like they totally catalyzed the change in the brokerage industry across the old guard, right? You had to go to commission-free trades across because they led with it. And now the retail army of investors is so big and powerful that the other brokerages had to have a part of it. We did have one viewer ask about Toast. What do you think about Toast right now? We've all seen it, interacted with it. Some people might think the market's saturated. How would you respond to that? Phenomenal growth, but where does it go from here?
They have like no international locations. They're in like a couple countries barely, and like they just started. And like everywhere you go, basically, like in restaurants like in New York or like where you are, like everybody has Toast. And you're like, well, why do you use it? Well, it saves them on payment processing fees. It does like, hey, your reservation's ready, right? And then it staffs their people at the right times. So it's like a comprehensive payment processing and software solution for restaurant businesses, right? So the first thing I think they do is they take that across the rest of the world, right? And they just start making a lot of money doing that because they're already profitable. And I think their profitability is going to expand a lot of these companies to reach 50 and 60% profit margins like we see in a company like Microsoft. The next thing I think that they're going to do is like, look, you have all these payment terminals, you have all this software to run them, you make your own hardware, right? So you're doing everything. Like, what's to stop you from like doing it for stores also?
Yeah,
you know what I mean?
Yeah.
Like they're already making websites for online ordering. Like, why don't you just go ahead and take on like Shopify while you're at it? So like, I see that like, look, I think like there's companies like Amazon, like they're a bookstore and then they become e-commerce and then they're like, well, we're going to do web services now. Yep. And it's like Toast has the potential to grow like that also. Like, and they have the potential to do it while making tons of money like they already are. So like, there's not a lot of risk.
It's low marginal cost for the next customer, but also low marginal cost to expand into an adjacent market opportunity as well for them.
That's the biggest thing about low marginal cost, right? So like every dollar you reinvest in business, you always make it better, right? So like when a traditional person like Boeing, they make an airplane, every dollar they put back into the business, they have to build another airplane. And that costs 99% of revenue, right?
That's right.
So it's
Yeah.
like, so it's like they can't, so like these companies like Toast or Microsoft can innovate at 50 to 100 times the speed. And they do. Like we've looked back 40 years ago, like, Boeing was making an airplane, ExxonMobil had a barrel of oil, and think about what Apple and Microsoft have done. And the question is, there's going to be like large cap companies that become like the future Salesforces also that kind of create this new market. I think Toast has the potential to be one of them, and I think Robinhood does too. And I think these are very exciting positions to have.
Well, listen, man, it's exciting to have you on. Chad Towers was just giving you the congratulations on your continued success. I want to echo the same thing. You've put together a very compelling strategy. It's not even just a strategy now. The performance is showing that it works. So I encourage people to check out your ETF, AOTG. You can go to AOTinvest.com, scan the QR code on your screen. And this, I think, is one of the perfect representations of how active management in the ETF space is leading to some really innovative solutions where the performance is delivering. So John, I want to thank you for being a pioneer in this space. I want to thank you for welcoming to share the New York Stock Exchange with you and your family, that experience. And man, I'd love to welcome you back to the show as we talk about your performance another 6 months, 12 months out from now, kicking butt like it has been so far.
Man, thank you for having me. This is a great show. I love all the educational content you put out to try to leave everybody better off. So it's an honor to be a part of it.
Well, we'll see you again soon, my friend.